and welcome to the channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture of my journey and development towards financial freedom. It will be about investment products, and it will also be about improving your financial well-being. So remember, if you like the videos, smash the like button, subscribe to this channel so it can reach a wider audience. Now let's get into this latest video. This week's video is about something relatively simple. It's called building wealth. Building wealth is not as complicated as hard as people think. It's just a lot of people do not know the basics. First of all, you need to do, quite simple shall we say, is make an active decision, make some kind of plan to build wealth for your future. Now, it's not a get rich quick scheme. It may take you 10, 15, 20 years. But ultimately, getting rich should be slow, it should be boring, but it should have an ultimate aim of reaching your financial goals sometime in the future. Biggest piece for most people to learn, shall we say, is delayed gratification. Put off things what you need now and it will reap the benefits at a later date, whether that's in 5 years, 10 years, 15 years. But learn some basics, shall we say. Automate your savings so that when you get paid or the first of the month, pay yourself first. Put it somewhere where you can grow that money, and do not save, invest that money. It will give you much greater returns. And pay yourself first. I think it's relatively quite simple, but unfortunately in the UK, we put a lot of emphasis on making it sound confusing because of jargon, the type of products involved, or it's out of sight of people's comfort zones. I'm going to show you a few illustrations of hopefully the returns of investing moving forwards. Now, it may well be you pick individual companies, it may well be you pick individual shares, but for most people the simplest thing to do is pick some kind of basic tracker fund or an ETF fund, which will trade the market. It will give you much more diversification, and those funds are normally cheaper than actively managed funds. Some kind of comparison, if we look at the FTSE 100 since it was introduced in 1984 to 2019, over 35 years, the actual price return has returned 654%, an annual return of 5.77%, and a total return with dividends reinvested of 1,377%, an average return of 7.75%. There will be good years, there will be bad years, but the aim is to be consistent and to think of long-term holdings to meet your investment objectives. And a quick comparison, most people would compare to the S&P 500, the 500 biggest stocks in America. Since its inception, in the current format in 1957, has given an annual return of over 8% year on year. So investment doesn't have to be complicated. Get yourself a relatively simple ETF or tracker fund. There are enough platform providers around. I'm not going to obviously publicize companies, but whether you use a platform, you use some kind of trading app, get yourself into the habit of investing. And to start off, learn the basics. Get yourself an ETF fund, get yourself a tracker fund, and then as your knowledge and experience grows, by all means diversify. Create wider sector of funds or holdings, or pick individual shares you may fancy, but think of long term. As we said, it is not a get rich quick scheme, but it will meet your goals and objectives moving forwards, and it's not as complicated as the market or the newspapers or the press may realise. The basis of market returns, we've just said some figures there of what the market will do, good years, bad years as I've stated, but some kind of context of illustrations. Say we did put £10,000 into the FTSE 100 way back in 1986, it would now be worth over £55,000. And if we put the same money in back in 1986 and we reinvested our dividends back into the market, we would have received a return to date of £197,000. So look at the difference. We've never had the dividend in the first place. It's reinvested, it's created more wealth, more dividends, more growth. As we said, a relatively simple exercise, but it just goes to show the aim of buying a selection of companies and holding them companies for a very long term period. And as we said, there will be good years, there will be bad years, as we found out through COVID, the last 12-18 months. But if time in the market is more important than timing the market. And one of the most important factors to think of when investing is compounding. As we said, leave your funds to grow year on year and it will build some kind of momentum, just like a snowball or just like a train going down a hill. As it gets more and more advanced over the years, the compounding will take greater effect. There's a rule of thumb, rule of 72, so for every 10 years, or if you made a return of 10% year on year, your portfolio will double every 7 years. And as Albert Einstein said, compounding is considered the eighth wonder of the world. Now, if we look at the following charts, just some illustrations of what the power of compounding can do. So, hypothetically, if we were age 18 and we put £1,000 in the market and we left it there, at the end of 10 years, at the age of 28, it would be worth £2,707. If we left it there for 20 years, so the age of 38, it would be worth £7,328. For 30 years, £19,837. For 40 years, £53,700. And then, hypothetically, for 50 years, say the UK state pension age of 58, it would be worth £140,000. That's on the basis is we put £1,000 and we left it there and we did not add any further investments. Looking at the following chart, same scenario, we put £1,000 in, but then we increased it every month by £100. Much better conditions, much better returns, but greatly improved figures. Again, at the end of 10 years, £23,362. At the end of 20 years, £83,897. 30 years, £247,000. At 40 years, £691,000. And then again, at the UK state pension age moving forwards of 68, £1.89 million. So it just goes to show the value of compounding and thinking about long-term investors. Imagine if someone said to you, at a relatively young age, you could have a pension pot or an investment portfolio of over £1 million. But it's about getting the basics right. Investing and thinking long term. Good years, bad years, beating the markets, but being consistent and staying in the market through the good times, the bad times, the recessions, the bull markets, etc. And probably the most important thing to do with your portfolios is make them tax efficient. So whether you put them into some kind of tax wrapper, such as an ISA, a lifetime ISA, a pension, a SIP, keep your investments tax free. Because when they will build up, you will get dividends. There will be no dividends tax to pay or declare. There will be no capital gains tax again to pay or declare. Okay, so keep your investments tax efficient, because when it builds up to a value later on, there will be no need to declare it, no need for self-assessments, and all your gains and profits will be clear from the HMRC and the tax office. So as we said, investing is relatively simple. You need to do a few simple things, but for some reason the industry, they confuse people, they bamboozle people. Now I'm not saying whether financial advisors are good or bad, okay, but people have a conception of the market. It is not confusing, but people do not understand one, investments, or maybe how the products work. So as we said, get yourself a plan, whether it's 5, 10, 15, 20 years or long term for retirement. Stick to the basics, and then as you improve, increase your knowledge, increase your investment products and awareness, but ultimately you will reach your financial goals. Remember, If you like the videos, smash the like button, subscribe to this channel, and we'll see you again soon.